How can a real estate investor making $350 a month on one property purchase a second property and now have to pull from savings just to keep both properties afloat? Let's talk about the 5 reasons scaling your portfolio too soon can destroy your profit. Reason number 1, you have no reserves. As a real estate investor, you are going to come across a lot of hidden costs and a lot of unexpected fees when owning your property. With that being said, having a reserve is a must. Reserve is money set aside to cover unexpected expenses. That's like not having auto insurance and driving around in a car. Everything is good until it's not. Then you get this huge expense and you have to figure out how are you going to pay for it. And that's exactly what happens. Your tenant leaves, your bills continue, you still have to pay your mortgage, you have to pay cleaning fees and repairs, and you have no rental income coming in. Let me explain the 3 different types of reserves. You have your maintenance and repairs, you have your capital expenditures or capital improvements, which covers your major repairs like your roof, your water heater, or your HVAC. And then you have your vacancy reserves. When putting money aside to cover your reserve, you want to take out about 30% to cover reserve. Then you want to split 10% of that to go towards your vacancy reserve, your capital improvement reserve, and your maintenance and repair reserve. You may want to also take out extra money for your taxes, but I would check with my CPA to determine how much I would need to take out every month to cover the annual fee. When you don't have reserve, you make desperate decisions. In the case where your property is vacant and you have these vacancy expenses, you may make the decision to be a little bit more lenient on your tenant screening, in which in long term could cost you more for having a bad tenant live in your property. Or you may make the decision to either pull from your savings account or get a loan just to cover the cost until another tenant moves in and you start receiving the rental income again. Here's a helpful tip. Start by taking anywhere between 5 to 10% depending on your budget and putting that money aside to cover those 3 reserve accounts. That's going to be 10% for maintenance and repairs, 10% for your vacancy reserve, and 10% for your capital improvements. Reason number 2, you're not stabilized. A deal may look good on paper because it shows that you're getting rental income, it shows minus your expenses, you have a profit, you feel confident about allowing a tenant to move in. But before you scale, you need to ensure that your first property is stabilized. A stabilized property means that you have allowed 6 to 12 months for rental income to be consistent and timely, your repairs are manageable, your tenant behavior is good, and your reserves are fully funded. That's like test driving a car. Everyone knows when you test drive a car and you just go around the corner, you haven't truly allowed the car to perform. It's going to take more miles, more time for you driving the car in order for you to know the true performance. That's exactly what happens when you scale too early before allowing your property to stabilize. For the first 2 or 3 months, everything is good. Then your HVAC goes out. Your tenant has moved out. You still have your bills, your mortgage, your repairs, and your cleaning fees that you have to pay for, and now your money is tied into this second property. This may lead to panic. You may have to pull from your personal savings account, you may have to get a loan, or you may make exceptions, which in the long run, making exceptions to your tenant screening can be more costly in the long run than it is waiting and getting the right tenant. So here's a helpful tip. Start by creating a ready to scale test. Before you scale, your property must pass every checkpoint. If it doesn't, then you need to retry this again in another 6 to 12 months. The checkpoint should include no major repairs, you have consistent cash flow, your reserves are fully funded, and your month ends are completed. Reason number 3, you don't know your true cushion. Most real estate investors think Once they receive their rental income and they pay their bills, whatever is left is considered profit. That is not correct. Your true cushion is going to include your balance after your monthly bills, after your mortgage payment, outstanding transactions, and after you've taken money and put it to the side for reserves. Not knowing your true cushion is like driving a car and not knowing how much gas you have. Just because the car starts up doesn't mean it's enough to get you where you need to go. You need to be able to determine how much gas you have to get to your destination. And that's exactly what happens when you look at your profit and you think it equals your rental income minus your expenses, but you haven't included your reserves. When you don't do that, this leads to inflated profit, exceeded owner's distribution, and you're unprepared for unexpected costs. Here's a helpful tip. Start by creating a reserve policy. A reserve policy is a rule that tells you how much to take out for reserve and which reserve account to create. You want to allocate anywhere between 5 to 10% to each reserve account being a vacancy account, a CapEx account, maintenance and reserve, and one for your income taxes. Reason 4, no reconciliation. If you have transactions coming out of your account every day, then you have a high volume bank account. That means reconciliation is a must for the success of your business. Reconciliation is matching your books with your bank account. That's like when I first got my bank account. They gave me about 10 blank checks and they gave me a check register book. And with this check register book, I was told to write all of my transactions down and make sure that I continue to update my balance. That way, when I look into my bank balance and the bank balance doesn't match my check register book, that means there's transactions that are still outstanding. For example, my bank register may have $40 in it, and my bank account may have $100 in it. In order to ensure that my bank balance and my check register have reconciled, I need to confirm which transactions are still outstanding so that the balance match my check register book. Here's where it gets risky. If you're not recording or you're trying to remember transactions that are not immediately debited out of your account, such as your rental income, checks, or ACH, you are putting your business at risk. This can lead to a huge financial disruption. You could take the chance of overspending, having returned checks, failed ACH, and overdraft fees. So here's a helpful hint. Start by either using a spreadsheet or using QuickBooks Online to record your transactions. If you're not able to use either one, then take a picture of every receipt that you receive and then find a way to record all those transactions. Then every week, you want to go into your bank account and categorize your transactions. That means labeling each of those transactions either under repairs, principal payment, property management, so that you have an idea of where your expenses is going towards. And then additionally, you want to make sure that you're reconciling monthly. Reason 5, bookkeeping without performance system. Most real estate investors rely on their bank balance to tell them if their property is a success. This is a mistake. Without proper bookkeeping and a system to track performance, you're not measuring the deal, you're guessing. Bookkeeping is tracking expenses. Bookkeeping is tracking transactions. Systems is measuring performance. Bookkeeping without performance system is like driving a car with no dashboard. You're not able to tell if your tire pressure is low, if you have enough oil, or if you have enough gas in your car to get to your destination. That's exactly what happens when you're doing bookkeeping, but you don't have a system in place to track your performance. Your focus is on having enough money to cover transactions, but what you don't see, expenses month to month, no visibility to reserves, you can't measure true cash flow, and you miss tax write-off. This leads to increased expenses, reduced profit, and blind scaling. Here's a helpful tip. Start by categorizing your transactions weekly. You want to track your reserves, how much equity that you have into your business by looking at your balance sheet and making sure you're completing a month end. Investors don't fail because of bad deals. They fail from unstable systems. No reserve, no tracking, no control. Scaling multiplies risk, not profit. If you're a new real estate investor or you've managed your own books and it's becoming too complex, this is exactly where problems start. I specialize in helping investors get their books back in good standing, identify hidden risk and profit leaks, and build a system where you can scale with confidence and not with guesswork. Schedule a diagnostic with my website for long-term, short-term, and flips, because scaling only works when your numbers can support it.